What if I told you that America has been in an economic depression for 2 decades? Measures of the real economy, such as real personal income, real GDP, and money velocity, have all fallen woefully short, missing targets by trillions of dollars. Meanwhile, the stock market and other financial assets, corporate profits, and government debt have soared to cover the gap. Something clearly changed in 2000, and today we will look at the data. So I want to follow up on the video we did on Japan covering their lost decades, I think is the term they use, prolonged period of very, very poor economic growth. And we talked about those dynamics in the Japanese video, how they applied to Japan. And I had mentioned that a lot of the same dynamics and trends and phenomenon could be noticed here in America. And so I want to go over some of those charts. And so what we have here, remember with the depression, a lot of people hear depression and they think the economy is shrinking at 10% per year. It is this, unemployment is 50%, right? It's a very, very severe recession, economic contraction. That's not actually the definition. The definition is a prolonged period of sub-potential, sub-trend growth, right? Industrial output, consumer spending, all measures of the real economy, a prolonged period of sub-trend, sub-potential growth. And so one of the easiest way to is to look at real GDP. This is gross domestic product, right, which is the aggregate economic output of the American economy, inflation adjusted. And what the next three charts, we'll go through a number of data points, but what these next three charts will show are logarithmic charts. What that means is this scale here is in logarithmic scale, meaning it is adjusting for exponential changes. And the reason is because everything in our economy is exponential. Here we have tax receipts. What is this? Real GDP, M2 money supply, and government debt. They're all in this line, and hopefully you can see that they're all parabolic. The S&P 500 is also parabolic. So in order to adjust for that, you put the chart in logarithmic form. So all of these, the next three charts will be logarithmic form. And that is just to visually adjust for that exponential change. It doesn't do anything to the actual underlying data. What I basically did for the next three charts, I took the growth from 1970 to 2000, that 30-year period, and I calculated the compound annual growth rate, the average growth rate per year for each of these metrics. And then I took that compound annual growth rate and I applied it to whatever the number was in 2000. So for example, from here, I took that measurement for that, 1970 to 2000, calculated what the compounded annual growth rate would be, what the average growth rate was, and then I just simply applied it. So in this example, real GDP in 2000 was $14.2 trillion. So I took this 4% compound annual growth rate, which is the average growth during this 30-year period, and I applied it to that number. And what I got was $37 trillion. And so I put a trend line here to that point, just a little bit below, it looks like. And so what this red box indicates is the missed GDP. The delta here indicates if we had kept the 1970 to 2000 growth rate for the real GDP, which means kind of inflation adjusted aggregate economic output of the American economy, if we had kept that pace from 1970 to 2000, our real GDP would be $37 trillion. Well, currently it's only $23.5 trillion. And we can see that, this clearly broke from the trend. And you can see that it started in 2000 and really kind of accelerated again or broke even further in 2008. I'm not the only person who has talked about this silent depression concept. I've done a lot of work on it, but many others have also done a lot of work. Jeff Snyder is one who's done some great work on this concept, and would recommend checking his stuff out. But the general idea here is that something changed in the economy in the past 20 years or so, and it's had pretty disastrous impacts for the average American. So what I want to show here in purple is M2 money velocity. We will look at this also later So pay attention. This purple line indicates the degree to which money is changing hands in the real economy, the velocity of money, kind of just as it sounds. This indicates, the degree, the rapidity, the velocity of money being exchanged in the real economy. And what we can see is that it peaked. Here's 2000, and ever since 2000, it has been straight down. Um, and it's not just money velocity either. Here we will look at this is the fiscal deficit as a share of GDP. And I will put a line here at 0%. And what we can see is that as a share of GDP, we actually ran a balanced budget as late as early 2001. But what do we see? The deficit as a share of GDP has been getting worse. That was basically the high. The best that we got was that early 2000s period where the deficit as a share of GDP was actually, we were running a surplus, right? It's below, excuse me, it's above this yellow line. That indicates a budget surplus, a fiscal surplus. Remember, the fiscal deficit is the difference between what the government spends and what they collect via taxes in revenue. And we actually ran a budget surplus. We collected more money than we spent uh, as late as 2001. But then ever since then, we have run ever larger fiscal deficits. And the last metric I want to point out here is real manufacturing output. Um, and this data on TradingView, at least, only goes back to 1985, 1987. But I've seen data that goes back to the 40s. And the chart basically just continues on this almost vertical, very, very sharp sort of uptrend, going back all the way to like the 40s. And then what happened? In 2000, it broke down and it never got back, right? It looks like in the lead up to the GFC, it tried to kind of make its way back to this trend, uh, but was just unable to. And ever since then, it's been basically down. We can see it set lower highs. So as a trader, this is a downtrend that we see here. And since 2000, real industrial output in America has basically been flat. We can see that 2000 here to here, I think I measured it and it's like 5%. Yeah, 10%. So real industrial output has only increased 10%. Compound annual growth rate of this, when I calculated it using the larger data set, was something like 25% per year. I mean, it was just astounding, the compound annual growth rate of the industrial output. We rebuilt Europe after World War II. We rebuilt the world basically after World War II. We were an industrial powerhouse uh, until we weren't. And I think what the data shows is that we've been suffering for a lot of those choices. So here's tax receipts. Remember, tax receipts. This is how the government makes money. This is the revenue side for the government. And I did the same thing. I calculated from 1970 to 2000 the compound annual growth rate, the average growth rate on a compounded basis. And I got 9.6%. This is very strong growth, right? If you're the government, this puts you in a strong economic position. And what do you know? We were in a strong economic position for that time period. Now, yes, there were hiccups along the way, but generally speaking, our GDP as a share of world GDP, our industrial output, right, like many measures relative to the world and the global economy, we were doing very, very well. And yeah, 9.6% CAGR. If you apply a 9.6% CAGR to the year 2000, what you get is 12 trillion. And this is actually incorrect. It's actually worse. So you get 12 trillion. Well, if you look at tax receipts, they're only 5 trillion in actuality. What this means is that the government is missing out on $7 trillion of tax receipts. Remember, we looked a couple videos ago at tax receipts as a share of GDP, and I will actually show that instead of just talking about it. And what we can see is that it's been basically flat. Um, it- I made the point that the government doesn't really have a revenue problem; it has a spending problem. We can see that as a share of GDP, going back to the 50s, this has basically hovered in a range and been basically sideways. So again, that 7 trillion of missed revenue, even if taxes only grew at GDP. We established that GDP should be growing much faster in this chart here, in the real GDP chart. So even if the share of tax receipts only grew at the kind of, the same pace as GDP, the government would still be making trillions more per year. And, maybe we wouldn't have a fiscal deficit. Remember, the fiscal deficit is about $2 trillion. And so for context, the delta, what the government should be collecting is $7 trillion higher. We currently collect about 5 trillion in tax receipts. And from this data, from that trend, what it appears, using the growth rate from 1970 to 2000, tax receipts should be closer to $12 trillion. And that difference of $7 trillion is a lot, is certainly notable. So this one maybe will hit the point home, kind of the most direct. So here's the same exact concept, taking personal income. This is just what it sounds, the total amount of income for Americans. I took the growth rate from 1970 to 2000, and then I found the CAGR, and it was growing at 10% compound annual growth rate. So even better than tax receipts were growing, which was 9.6. And I applied that 10% CAGR to 9 trillion, which is what tax receipts were what personal income was in the year 2000. It was about 9 trillion. So I applied that 10% CAGR. What I got was $86 trillion. Um, Currently, personal income is only about 25.5 trillion. So what this means is that in terms of income for the average Americans, there's a $51 trillion gap that is not being filled. Put another way, personal income should be 200% higher than it actually is. The difference between, again, using this CAGR from 1970 to 2000, just using that same growth rate and applying it to 2000 to 2025, we should have personal income 200% higher than it currently is. And I did the math. This works out to $27,000 per taxpayer per year. So hopefully that maybe hits it home, or makes it more, these concepts more relatable. And some people might be starting to notice in this particular chart, that there was kind of another trend change in this personal income. You can see here, I'll try to draw it as close kind of as possible. There was this very steep uptrend here, and in the early 80s, it started to diverge. Hopefully you can see that. Well, I want to point out in red here, this red line is the balance of trade. And I will draw a red line to show a balanced trade. So balanced trade, that's about balanced trade. What do we see in 1980? It is the first time that we start running a significant trade deficit. Um, I think that's notable. There's a couple other notable things. 10-year Treasury here in yellow peaked in 1980, and what do you know? Ever since then, the 10-year Treasury rate has been falling, and um, the trade deficit has been blowing out, getting more severe. I'll try to clean this up. But you can see that both the trade, we were running balanced trade as late as, I mean, for a very brief period in 1982, but really kind of the last time was this late 70s, early 80s where we ran balanced trade. And in the 80s, right, when personal income started to diverge from its trend, this kind of steeper trend that we see from the kind of 50s through the 60s, that populist era I keep talking about, um, we see that the US started to run a large trade deficit. And now, this looks tame in comparison to the $140 billion a month trade deficit we have now. But remember that the economy was significantly smaller, right? The money supply was significantly smaller. A $14 billion trade deficit in 1980, as a share of GDP, that was a significant trend change, especially since you can see the US kind of historically ran relatively balanced trade. There was this brief period of time in the mid to late 70s where we ran a small trade deficit, but hopefully it's clear that the trade deficit really became severe in um, in 1980. Hopefully, this will illustrate it a little better. So yeah, you can see that, and you can also see the peak in 10-year Treasury yields. But 1980 was when we started to run a very large trade deficit, and sure enough, that is exactly when personal income kind of made its first little trend change right here in the early 80s. So I think that that's notable. The other thing I will point out, in addition to the 10-year Treasury yield peaking there, is that here we have S&P 500 divided by the average hourly wage. And I love this chart because it's a very simple concept. This shows the degree to which the S&P 500, as a proxy for financial assets, has outperformed the average hourly wage. And sure enough, this period of populism that I keep talking about, the S&P 500 was actually underperforming the average American. So put another way, the average American, their wage growth was higher, faster than the S&P 500 was growing. Well, what happened in the early 80s? It set a bottom and boom, it broke out of that downtrend and has been headed higher ever since. Just for context, in 1982, June of 1982, um, it took 15 hours of work at the average job to buy one share of the S&P 500. At the peak of the dot-com bubble, it was about 106 hours of work at the average job to buy one share of the S&P 500. And at the peak in kind of early 2025, it was as high as 197 hours. So we went from 15 hours of work at the average job to buy one share to 200. This chart, if I had to pick one chart to show to demonstrate the concept of hyper financialization, it would be this chart. This is like one of the more insane charts that I think I've ever come across. And so it's, I think, important to point out that that trend, that populist trend of kind of the bottom 90% winning out and actually outperforming, that trend clearly changed in the 80s, in the early 80s, and it just so happens to correspond to kind of the start of this trade deficit that we know has only gotten worse kind of ever since then. So I think that this is a notable correlation, and hopefully you can see just by overlaying these the I will invert this. That correlation to me is pretty damning to running a trade deficit. Now, this shows there are clearly winners, right? A current account deficit, a trade deficit. Also, the other way to think about it is that is a capital account surplus. That means foreigners are recycling dollars into your financial markets to the tune of whatever your trade deficit is. So our current account deficit is slightly less than 140 billion, which is our trade deficit. But just to make it very simple, let's assume the current account deficit is about 140 billion dollars per month, which is what the trade deficit is. What that means, the other way to think about that is that $140 billion per month must flow from the rest of the world back into our financial markets. So, if the purple line is this hyper financialization concept and the red line is the trade deficit, inverted, right? As the red line goes up, trade deficit's getting worse. We can see that I mean, this is a strong correlation. It even has, this degree of kind of this little peak and then the pullback. It has it in both lines right here in the early 2020s, right? Like this correlation, in my opinion, is extremely notable. How tight this correlation is, and the reason is structural. The reason is that by running an ever larger trade deficit, we are guaranteeing that those who own financial assets basically have a guaranteed bid into their assets from the rest of the world. Now we know that the distribution of financial asset ownership in America, that the top 10% own 93% of U.S. stocks. So is this helping the bottom 90? Doesn't seem so. The average American only has $50,000 in the stock market. It is really the top 10% that owns all the stocks. And so, it makes perfect sense why kind of the elite and the wealthy are so upset at trying to decrease this trade deficit, decrease this current account deficit, because it removes a structural bid into the financial assets that they own disproportionately. And so here, I kind of combine these two concepts. So in the top pane here, we have three different measures of kind of the real economy, the bottom 90%. Real personal income, and that is the same number we were looking at earlier over here, that I had right there in white, this white one that started to diverge in the 80s and made another divergence, is that same metric. But then I divided it by M2 money supply. Remember, inflation is a monetary phenomenon. It is directly due to the money supply expanding. So you take that personal income number and you divide it by M2, and that gives you a real inflation adjusted personal income. And then in yellow, we have money velocity. We already covered that concept. And then in orange, we have real disposable income. This is very similar to personal income, just kind of the money left over. And again, I adjusted it by denominating it via M2, so adjusting for inflation. So the white and orange lines are adjusted for inflation, and the yellow line is the same money velocity metric we looked at earlier. And what you can see is that from the early 60s all the way until 2000, the average American, this chart, this upper pane here, is the bottom 90%. This is the bottom 90% that work for a living. What we can see is that not only do all three of the lines basically look the same, right? Which indicates to me that money velocity, that these two, that this real personal income and this real disposable income, by dividing it by the money supply, to me, the fact that those two metrics line up so well with the money velocity, to me, just shows the validity in using M2 as a denominator. So I'll just make that point. And then, point out that for many decades, the average American was gaining in real inflation adjusted terms. They were outperforming inflation. Their wages were growing faster than the money supply was growing. And then something changed in 2000. And we can see that for the past 2.5 decades, the average American has just been getting crushed. And then in the bottom pane, so you hear on the news, oh, the economy's so strong. The economy grew at 2.8% this quarter, and right, all this kind of very positive news about how strong and how great the American economy is. If kind of the real economy, which is the degree to which money is changing hands, right? The degree to which inflation adjusted income is growing. This is the real economy. Well, we know that that's been shrinking for 2.5 decades, that the average American has been underperforming inflation, and money velocity has been plummeting. So we know that. So, well, how is GDP positive? How do these economists get on TV and say everything's so great? Something has to be outperforming. And what is outperforming? So I will kind of hide each one of these, go through them one by one, since I know it can be a little busy. Here in green, we have corporate profits divided by GDP. So again, when this green line is going up, corporate profits are increasing at a faster rate than GDP is. When this line is decreasing, GDP is growing faster than corporate profits. And again, this populist era from the early 60s all the way through to the early 90s, really, for this particular line, was declining. Corporations were actually underperforming the overall economy. And then what changed? In the late 90s, this kind of broke out from its downtrend here, and started heading higher. And remember, this is corporate profits as a share of GDP. Here we have financial assets, so the S&P 500 as a share of GDP. And again, it's the same general trend, this populist era where the average, kind of the bottom 90%, was actually outperforming the overall economy. The S&P 500 and financial assets were underperforming. We've talked about this number of times, but then something changed, right? And the S&P 500 and other financial assets started to radically outperform. And this is evident through the blue line here that we see. Government debt to GDP, government debt as a share of GDP, had been declining from the 60s into the early 80s when it set its bottom here at 30% debt to GDP. Debt to GDP now is 120%. And again, hopefully it is clear by now that the point I'm trying to illustrate here is that as these three kind of measures of the real economy, as they have been plummeting for the past 2.5 decades, something had to step in to fill the gap. And we know just from looking at this data that it is corporate profits, S&P 500, and government debt. That is what has stepped in to fill the gap and give us this quote unquote strong economy that all the economists go on the nightly news to talk about. Whether or not that's actually a strong economy is up for debate, in my opinion. I would argue that a strong economy is where the bottom 90% are at least, at the very least, keeping pace with GDP, keeping pace with inflation. But we know that they're actually underperforming inflation and the overall economy. They are losing out, right? The pie might be growing, but what we see is that labor, or the bottom 90%, are getting a smaller piece of that growing pie. And we see corporations, those who hold financial assets, and the government, kind of writ large, they are getting an ever expanding share of that pie. Um, whether that's a great economy, maybe leave a comment, tell me your thoughts. But it's not just these three metrics. There is a third and final or fourth final metric that I think is really important to point out. And we touched on it a little bit earlier. Here's real GDP. And this goes all the way back to the mid 50s. And this is a year over year chart. So this white line indicates the degree to the rate of change of real inflation adjusted GDP. And we can see that from the mid 50s all the way through to 2000, the majority of the time was in this red box. Well, that indicates 2.7% real inflation adjusted growth, all the way up to 9%. The majority of the time, the American economy, yes, there were hiccups and short-lived recessions where it would drop below the dotted yellow, which is 0%. There were short periods of time where we'd have a recession, right? But in general, the majority of the time, real GDP was above 3.7%. And I mean, if you look here through the 60s and the 70s, I mean, we had very strong growth. We're talking 5, 6, 7, 8% real inflation adjusted growth. Well, what happened after 2000? We see that it's actually the opposite. So while this kind of 3% line was acting as a bit of support, right? Before here, where it would come down, bounce, 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 right? It was bouncing on 3%. Now we see that it's actually acting kind of as resistance. And so this red line is 2.8% real GDP growth. And we can see that comes up, bumps its head back down, close to 0% in 2011, right? We had less than 1% real growth in this measure in July of 2011. And hopefully this is clear, right? That what used to be support for real GDP for the past 25 years has actually been acting as resistance. And the real economy has been growing much more slowly than it should have been. And again, this white line here is just another way to kind of visualize this line, right? This is the real GDP, the actual metric, the actual number itself is this white line. And it is the same data. This just takes that data and finds out, on a year over year basis, how fast is this white line growing? That's all that it is. It's the same data. And we see the same thing, which is that real GDP started to um, lag behind, and we have been in this kind of prolonged period of really poor growth. Now it's currently about 2%. Is that poor growth? Well, if you look at it just, from, I don't know, -10 to +10, and you hear the number 2, you might think, "Oh, well, that's all right." But the point here is the potential. The point here is what 30, 40, 50 years of history was showing. The potential that the American economy had, and what it had demonstrated that it could grow at, right? That the average American could have strong wage gains. I think that's what's really important. And just to finish up, I want to point out one really, really important metric, data point, which is people talk about this China shock. And what the China shock was when China was admitted into the World Trade Organization. And I mark that line here. I will make it solid. I will make it red. This was when China was admitted into the World Trade Organization. Um, and you know, I have noticed this kind of 2000-ish, right, early 2000s peak in many things that I've pointed out in many of my videos that all seem to peak kind of in that early 2000s. Now, whether or not it's a direct causal link to kind of increasing globalization, I believe that there's enough data that demonstrates that is true. And just conceptually speaking, it makes kind of perfect sense. But you know, maybe you can contest that. I think the fact that so many things peaked in the early 2000s, and that just so happened to be when the trade deficit started to blow out because China was admitted into the World Trade Organization and given most favored nation status, right? Globalization really kind of accelerated. Um, I think the two are at the very least correlated, and at the most, I would argue the data that I have come across and compiled and analyzed myself. It seems the data is pretty overwhelmingly clear. Now, like the Democrats in the 90s warned about this. They warned that the average American, the average worker, that labor share of income in the overall economy, they warned that this exact thing would happen. Chuck Schumer, Nancy Pelosi, Bernie Sanders, all these people, they all warned accurately that taking globalization, this kind of hyper globalization, would lead to this exact outcome, which is the bottom 90% do poorly. And meanwhile, what does well? Well, the top 1%, certainly the top 10%, does exceedingly well. And remember, the net worth of the top 1% and the inverted trade deficit is basically the same line. And so, this is just due to the structure of the system with these capital account surpluses. The Democrats warned of this, like why they are not kind of taking a victory lap, and pushing to kind of help, I guess. I'm the first person to say that the implementation of some of these kind of trade policies has been very chaotic and kind of unpredictable. But what I would like to see is this is one of those moments where the bottom 90% can kind of get together and go, look, the top 1%, they did exceedingly well. The federal government did exceedingly well. Corporations did exceedingly well from globalization, from hyper globalization. The average worker, on the other hand, the bottom 90% of America got absolutely crushed in this kind of hyper globalized economy. Let's like that. To me, that just seems like the perfect, the most straightforward uniting force in America today. Um, and why there's not more of a cooperation to address the utterly insane trade deficit that we have. I mean, uh, this red line, this is the trade deficit. I mean, the fact that $140 billion a month is flowing out of America and into the pockets of foreign countries, is, I think, the kind of thing that both parties, and certainly the bottom 90% of Americans, should be able to unite behind and go, yeah, maybe that's not such a great thing. Let's try to balance trade, or at least let's try to, at the very least, let's try to minimize, bring this trade deficit down from $140 billion per month. I don't know, if we could just bring it down back to $70 billion per month, that would be a huge improvement from where it's gone. But the fact that the S&P 500 divided by the average hourly wage, again, this purple line is basically hyper financialization as a line, as a metric. Um, the fact that these two are so correlated to me is just an indictment on the structure of the system, right? An ever expanding trade deficit guarantees a capital account surplus. And the final point I will make is on the debt, in the context of this kind of silent depression concept. So here in red is the real yield. This is the 10-year treasury minus the annual inflation rate. And what we can see is that, again, we talked about that 1980 period where personal income had peaked. I took the line off, but 1980 was when that personal income really kind of started to flatten out. Well, we pointed out the 10-year treasury peaked in 1980, and the real yield, the real inflation adjusted yield, also peaked in 1984 at about 9.5%. And what did it do ever since? It was in this downtrend. And so as the government debt to GDP is increasing, if the cost of that debt is decreasing, right? This is basically showing the cost of all that new debt. If the cost of the debt is decreasing, the government can manage, right? The government can afford to take this debt to GDP higher so long as the cost of the debt goes lower. And of course, it depends on the percentage change, and that's, you can only take yields so low, but generally speaking, that's kind of what we've done is to fill the gap, not only corporate profits and financial assets, but to fill this gap in the real economy. One of the ways that we've been kind of trying to deal with it is just issuing debt. Well, that works so long as the interest rate, the real cost, right, the inflation adjusted rate is declining, right? So long as it's declining, we've kind of gotten away with doing this. Um, well, it's not declining anymore. In fact, it's moving pretty sharply higher and breaking out of this downtrend. And again, this I'm not saying there's going to be a debt crisis tomorrow. Anyone familiar with my videos and stuff, I am not trying to be one of those people claiming that the sky is falling. What I am trying to point out is the macro trends. Just as we were kind of zooming way out and looking at these, kind of these big, massive, multi-decade long trends up and down, right? And different things, trying to get a picture of what is actually kind of underneath the surface. Just as we were doing that with these metrics here, I think it's important to look at interest rates in the bond market and growth and inflation in the same way, which is we have been in a 70-year period of declining interest rates. And this lines up, by the way, with structural demographic theorists like Peter Turchin and Neil Howe. They talk about these long lifetime debt cycles. And so I think that when it comes to filling in the gap with debt, with government debt, as we showed here with the dark blue line, as you can do that so long as the cost of the debt goes down. But what we have seen is that the cost of the debt is actually moving higher. It's breaking out above 0%. Anytime this red line was below yellow, the government was basically incentivized to take out debt. People were guaranteed a negative return, negative real inflation adjusted return. And if you're a trader, that downtrend is pretty evident right there. And we decisively broke out to the upside. And in my opinion, all the disinflationary forces of the past, I don't know, 2, 3, 4, 5 decades, globalization is clearly coming to an end or reversing, right? And not just in America, not just with Trump and all his administration. Even the prime minister of the UK, which is kind of they are much different politically, I guess you could say, than Trump. Even they are starting to admit, look, like globalism kind of failed the vast majority of Britons, and the bottom 90% actually came out worse off. Globalism failed. The prime minister said those words. This is kind of an emergent trend, not just in America, but all over the developed world. So globalization is clearly kind of starting to reverse. That is inflationary. Demographics, are a huge issue. The fiscal and debt issues in America, not just in America, but the developed world. We are running a 7% of GDP budget deficit, and it's expected to go towards 8%, right? That is incredibly inflationary. As is kind of the ever growing deficit, right? So all of these forces that were disinflationary are all reversing. Now we do have one final trend that is positive in a disinflationary direction, which is technological advancements. AI and robotics, in my opinion, will probably be very deflationary. Um, but I think we're still a ways off from seeing the real benefits, the real actualized benefits from that. And so, as the cost of debt starts to increase, you can see this has happened before. The difference is that the debt to GDP back here was like 30%, right? During People draw a parallel to the 70s and 80s, but they forget that the debt to GDP was like one third, one fourth of what it is now. It's a lot different when you have a spike in the real yield when your debt to GDP is 120%. And just headed higher, right? The higher this red line goes, the higher that debt to GDP line will go. So, anyways, hopefully that was helpful. There's a lot of concepts here. I'm curious for people's thoughts. If you feel like you've been in a depression for the past 20 years, clearly there have been some winners. Clearly there have been a lot of losers. So I'd be curious, kind of to see the distribution of how people feel about that. But yeah, hopefully that was helpful, educational, interesting. And yeah, leave a comment with your thoughts, and I'll see you later.